Viewers at home, you are welcome to the part 2 of my presentation on business valuation. Business valuation. Business valuation. In part 1, I have examined the net asset method of valuing business. In this part 2, I want to use the earning basis method of valuing business. Earning basis or earning method of valuing business. I've told you that valuation of business means the determination of the market value of the business. Anytime you want to value the business, that means you want to determine the market value of that business. So, earning basis is a method of estimating share prices when substantial shareholdings are involved. When substantial shareholdings, whenever it is involved, and if you want to estimate the market price or the price of that shares, you use the earning basis method. I repeat, I said whenever shareholdings, that is the parent and subsidiary, when shareholdings are involved. So to estimate the value of the business, I said the method you should use is earning basis method. This method is used when investors want to buy shareholdings or when two or more companies want to merge. When you want to merge 2 or more companies, you can as well use the earning basis. Or when the investor want to buy large shares. So under this method, I want to examine the price earning basis. Price earning basis. So in my earlier presentation, I've examined the price earning ratio. I said price earning ratio, I said it's the ratio of the market price to earnings. The ratio of market price to earnings, or market price per shares over earning per shares. If I say earnings, I'm referring to profit. The profit that is attributable to shareholders is the profit after tax. So the one that belongs to ordinary shareholders is the profit after tax. That means the earnings here should be profit after tax. So after you either use total market value or total market price over total earnings, or you use the market price per shares over earning per shares. Under the price earning ratio, or we either use price earning ratio or you use the earning yield. Whether it is earning yield or market price, it is the same. So under the earning yield, if it is earning yield is just the reciprocal of the market price per share. That is, if you want to use the price earning ratio now, what would that be the market value? Just make the market price the subject of the formula. Therefore, market price of the shares will be, you just cross multiply, which is price earning ratio times earnings. That is, I've told you that earnings mean profit. This times this will give you this. Market price, if you have this over 1, this times 1 will still be market price. P ratio times 1 times earnings. So the formula becomes this. That is if you want to use the price earning basis. And if you want to use the earning yield from our ratio analysis, earning yield is the reciprocal of the price earning ratio, and the formula is the earnings, total earnings over total market price or total market value, whichever one you call it, either market price or the market value. Or I said it is the same as earning per shares over market price per shares in our ratio analysis. For better understanding, you can as well watch my earlier presentation on ratio analysis, interpretations of financial statements. So if earning yield equals to earning per shares. If earning yield is earnings over market value, so meaning that to value the business, what you want to determine is the market value. Just make your market value the subject of the formula. If you take this over 1, that means if you cross multiply, you have your earning yield times market value equals to no, I'm cross multiplying. By multiplying this with this or by this equals to earnings. I've told you that if I say earnings, I'm talking about the profit. Earnings mean profit. I've told you that the profit attributable to ordinary shareholders is the profit after tax. Therefore, if I say earnings, I'm referring to the profit after tax. So make your market value the subject of the formula. That means to make your market value the subject, you divide both sides by the earning yield. Therefore, market value now, market value will be equal to total earnings over earning yield. Earning yield. This formula will be used where there is no growth in earning. But anytime there is a growth in earning, the formula becomes earnings, which is your profit after tax, into 1 plus growth rate over earning yield minus growth. That is the market value. Market value using earning yield basis. So the next one I'm going to examine is dividend yield basis. Dividend yield basis. I've told you that dividend yield is equally similar to earning yield. Dividend yield basis. Dividend yield basis. This is similar to earning yield, only that your dividend yield, instead of having earning per share, so it becomes dividend per shares over market price per shares, or you use the total dividend. The dividend to consider must be the one attributable to ordinary shareholders over total market value. Total market value. That is dividend yield. Dividend yield. I've told you that to use this model to value business, what you want to determine is the value of the business. Just make the total market value the subject of the formula. So the formula becomes this times this, which is dividend yield times total market value. Total market value equals to total dividend. Total dividends. So to make your market value the subject, you divide both sides by dividend yield. Therefore, total market value, which will now be total dividend, divided by dividend yield. This formula will be used where there is no growth in dividends. But anytime there is a growth in dividend, the formula can be modified. Where there is a growth in dividend now, where there is growth in dividend, the formula will be modified. So that means total market value will now be equals to total dividend. Let me have dividend in the base year. Total dividend in the base year into 1 plus growth rate over dividend yield. Dividend yield minus growth. That is the formula where there is a growth in dividend. Now, example. Recent financial information relating to Close Co, a stock market listed company, is as follows. Amount in $1 million. Profit after tax, earnings 66.6, dividends of 40.0, statement of financial position information, non-current assets 595, current assets 125, total assets 720, current liabilities 70, equity ordinary shares of $1 nominal 80, reserves 410, total equity is 490. Non-current liabilities, which includes 6% back loan of 40, 8% bonds, $100 nominal 120. The total of the non-current liabilities is 160. Equity plus liability is 720. Financial analysts have forecast that the dividends of closed co will grow in the future at a rate of 4% per year. This is slightly less than the forecast growth rate of the profit after tax earnings of the company, which is 5% per year. The finance director of a closed co thinks that, considering the risk associated with expected earnings growth and earnings yield of 11% per year, can be used. For valuation purposes, closed co has a cost of equity of 10% per year and the before tax cost of debt of 7% per year. The 8% bonds will be redeemed at nominal value in 6 years' time. Closed co pays tax at an annual rate of 30% per year, and the dividend share price of the company is $8.50 per share required. Calculate the value of closed co using the following methods. The first method is net asset value method. 2. Dividend growth method. 3. Earnings yield method. B. Calculate the weighted average after tax cost of capital of closed co using market values where appropriate. That is the question. This question is obtained from Practice and Revision Kit, ACCA by Kaplan. Now let's have the solution. Financial management solution. So the first method, you have to calculate the value of closed co using the following methods. You want to use net asset value method. Value of closed co. You want to use net assets method. Net asset method. Amount in $1,000,000. So you are going to, under the net asset method, I've told you that you are going to use, since the market value of the asset or the realizable value of the asset and the replacement price of the asset is not given, so the book value method should be used. Remember, if you have watched my previous or earlier presentation on valuation of business, where the net asset method were comprehensively examined. So you will agree with me that whenever the market value or the realizable value of the asset, where it is not given, or the replacement price is not given, then the book value method should be used. Now we are going to use the book value of the asset. The first asset we have non-current asset 595, and then we also have current assets 125. So we have non-current assets. The book value is 595, and then we also have current assets, with the book value of 125. Then we have the total assets of 720. By the time you sum it up, from this, I've told you that when you are using the net asset method, goodwill should be excluded unless it has a market value. But since there is no goodwill, so that means your net asset will still agree with the amount given in the statement of financial position. Now, let's the liability. The liability we have includes non-current liabilities, which includes 6% bank loan. Net asset mean equity or total assets minus current liabilities. So non-current liabilities, which include 6% bank loan of 40 and 8% bonds of 120. Now we less the liabilities. Less liabilities. The non-current we have 6% bank loan, and that amounted to 40. Then we also have 8% bonds, 8% bonds, which amounted to 120. Then we also have current liabilities of 70. Current liabilities of 70. So by the time you sum up the liability, 40 plus 120, that is 160. 160 plus 70, liability is totaled 230. If you subtract 230 from 720, then we have 490. That is the value of close co. If you use the net asset method, the close co value is 490, which agree with the value of equity. You know, the total value of equity is 490. Remember, I've told you that equity is the same as the net asset. So the value of close co now is 490. Remember, how many shares does close co have? Close co equity, ordinary shares of $1 nominal, which is 80,000 or 80 million. Remember, amount is in million, so 80 million. So if you have 80 million divided by 1, that means close co is having 80 million shares. Now, value of close co now on the basis of the net asset method. Now, using net asset method now, what will be the market value per share? Value per share. So since you have the net asset to be 490 million and the number of shares of close co is 80 million, so if you have 490 divided by 80, that gives us 6.13 dollar per share. That is the value of close co using net asset method of valuation. Now, my figure 2, using dividend growth method. I tell you that the market value under dividend growth will be equals to the base dividend into 1 plus growth rate over R. R is cost of equity minus growth. R is the cost of equity. How much is the base dividend? Our dividend is, back to the question, we are given profit after tax, which is earnings 66.6, and dividends of 40. Dividend is $40 million. The growth rate is the growth rate in dividend. Now, we were told financial analysts have forecast that the dividends of Closco will grow in the future at a rate of 4% per year. That is the growth rate in dividends. The growth rate is 4%. So our G is 4%. And what is the cost of equity? R. I've told you that R represents cost of equity. Let's read further. This is slightly less than the forecast growth rate of the profit after tax earnings of the company, which is 5% per year. The finance director of a Closco thinks that considering the risk associated with expected earnings growth and earnings yield of 11% per year can be used. For valuation purposes, Closco has a cost of equity of 10%. Cost of equity is given to be 10%. So meaning that our R is 10%. Now, substituting into the formula. So our market value now, market value equals to the dividend, which is 40 million, into 1 plus G, and our G is 4%, 0.04 over R, which is cost of equity, which is 10%, 0.1, minus growth rate, which is 4%, 0.04. So by the time you add 1 plus 0.04, you have 1.04. 1.04 times 40 million, that will be 41.6 million over, if you have 0.1 minus 0.04, that gives us 0.06. 41.6 million, 41.6 divided by 0.06, that gives us 693 million, approximately equal to 693 million. That is the total market value of the company. Remember, you have to calculate the value of the firm. I've told you that to calculate the value of the firm, it means to estimate its market value. If the total market value is 693 million, how much is the market value per share? So market value per share now will be 693 million divided by number of ordinary shares. Our ordinary shares is 80 million divided by 1, which is still 80 million. So we have divided by 80 million. So 693 divided by 80, that gives us 8.66. Therefore, the market value per share of the firm, that is of Closco, is approximately equal to $8.66 per share. So that is the solution to Roman figure 2. Roman figure 3. You are to calculate the value of Closco using earning yield method. Using earning yield method. I've told you that under earning yield, since I've told you that earning yield, the formula for calculating earning yield is equal to earning per shares over market price per share. And when we make the market price per share the subject of the formula, so you have the market price per share equals to earning per share over earning yield. And I've told you that you can equally use the total. That means you use the total earnings. Total earnings is total profit and over earning yield. The total profit after tax, meaning that the total market value total market value using ACCA method will be total profit or total earnings, total profit after tax over earning yield. And our profit after tax, you were given the profit after tax, which is the same as your earnings, which is 66.6 million. So that means the numerator is 66.6 million over earning yield. And what is our earning yield? Now let's read the note. Financial analysts have forecast that the dividends of Closco will grow in the future at a rate of 4% per year. This is slightly less than the forecast growth rate of the profit after tax earnings of the company. So in this case, in this question, the profit after tax growth, there is a growth in our part. Since there is a growth in the profit after tax, that means this formula will require further modification. Therefore, total market value, since there is a growth in part, that will be part into 1 plus growth rate over earning yield. Earning yield minus growth. So just like the formula we use for Roman figure 2, only that this becomes the part and our earning yield, our cost of equity becomes the earning yield. So the formula is still the same. Our part, profit after tax, is 66.6 million. 66.6 million into 1 plus growth rate. And the growth rate in earnings, this is slightly less than the forecast growth rate of the profit after tax earnings of the company, which is 5% per year. The growth rate in part is 5%. You have over 5%, which is 0.05 over earning yield. And what is the earning yield? Now, the finance director of Closco thinks that considering the risk associated with the expected earning growth, an earning yield of 11% per year can be used. The earning yield is 11%. So which is 0.11 minus growth. And the growth rate in earnings is 0.05. So if you have 1.05, if you add this, 1 plus 0.05 will be 1.05 times 66.6. The numerator is 69.93. 69.93 over denominator is 0.11 minus 0.05. The denominator is 0.06. If you divide this, 69.93 divided by 0.06, that gives us 1. Therefore, the total market value of Closco is $1,166,000,000. Therefore, what will now be the market price per share of Closco? So when you divide the total market value of 1,166,000,000 by the number of shares in EU, we have ordinary shares of 80 million. If you divide it by 80 million, so 1,166,000,000 divided by 80, then you have 14 point. Therefore, market price per share will now be 14.14 $0.58 per share. So that is the solution to the requirement A. B, you are to calculate the weighted average cost of capital of closed co using market values where appropriate. You want to calculate the WACC, calculation of weighted average cost of capital of closed co. So we have capital structure. Capital structure which comprises equity or ordinary share, and the debt. The debt comprises 6% bank loans and 8% bonds. We have bank loans and bonds. What is their market value? Amount in million. There will also have cost of capital. Then we have hash total. Now for ordinary shares, what is the market value of ordinary share? Back to the note. You were told closed co has a cost of equity of 10% per year. So the cost of equity of closed co is 10%. Equity, that is ordinary shares. And a before tax cost of debt of 7% per year. Cost of debt before tax, cost of debt which is bonds, that is pre-tax cost of bonds which is 7%. Now you will need to calculate the post-tax cost of bonds by allowing for the tax. Know the tax rate, pays tax at an annual rate of 30%. You have to eliminate tax from it. Now post-tax cost of debt. Now post-tax cost of debt, which will now be equal to pre-tax cost of debt into 1 minus tax rate. For better understanding, go and watch my presentation on cost of capital. So pre-tax cost of debt you were given to be 7% into 1 minus tax rate is 30%. So which is 7% into 1 minus 0.3, that would be 0.7. So which will give us 4.9%. That is post-tax cost of debt, which is 4.9%. So debt, that is bonds, 4.9%. So now let's forge ahead. Closed co pays tax at an annual rate of 30% per year, and the ex-dividend share price of the company is 8.5 per share. So this is the market value of the shares. Market value of the share. So what will now be the total market value? If market value per share is 8.5, what will be the total market value? Total market value of closed co shares. Remember, one is 8.5 times number of shares in issue. The number of shares in issue is 80 million shares divided by 1, which will be 80 million. 80 million nominal value divided by the nominal value per share. So you have 80 million. 8.5 times 80, that gives us 680 million. The total market value of closed co ordinary share is 680 million. So what will now be the hard total? 10% of 680 million. That gives us 68 million. Now let's read the note for other information. Financial analysts have forecast that the dividend of closed co will grow in the future at a rate of 4% per year. This is growth rate in dividend. This is slightly less than the forecast growth rate of the profit after tax earnings of the company, which is 5% per year. The finance directors of closed co thinks that considering the risk associated with the expected earnings growth, an earnings yield of 11% per year can be used. So there is no further information about the cost of the bank loan. Therefore, we are going to use the coupon rate. That is the coupon rate. That is the kind amount, the amount in the statement of financial position will be used for the bank loans. Now, the coupon rate now is 6%. Bank loan attract interest at the rate of 6%. This 6% is the pre-tax cost of the bank loans. So you will need the post-tax cost of the loans for bank loan now. Bank loans, if pre-tax is 6%, so when you allow for tax, that means post-tax cost of the bank loan will be 6 times 0.7. That gives us 4.2%. So for bank loan, you have the 4.2%. What is the market value of the bank loan? Since you were not given any further information about the bank loans, the value as per the statement of financial position, which is the carrying amount, will be used, which is $40 million should be used. So we have the market value. We are using the book value in lieu of the market value. 4.2% of 40 million. You have 1.68 million. Then we also need the market value of the bonds. Market value of the bonds. You were told that the 8% bonds will be redeemed at nominal value in 6 years' time. This is a redeemable bonds. So now you will need to determine the value of the bonds. So to calculate the value of the bonds, value of the bonds of the 8% redeemable bonds, So you calculate the present value of the bonds. So you have year, the items, and cash flows. Cash flows. The first year, so it will be redeemable in 6 years' time. So redeemable in 6 years' time. Since it will be redeemable in 6 years' time, so we have the year 1 to 6. So we have interest as one of the cash flows. If you calculate interest on the bonds, 8% of the nominal value of the bonds, it will still be 8 million. So in the year 6, you have the redemption value. How much will be repaid at the close of the period? Close, you were told that the 8% bonds will be redeemed at nominal value in 6 years' time. The nominal value of the bonds is denominated into 100. So you have $100. That is the nominal value of 100. So discount factor at what is the discount factor given? You were given 7% as a discount rate. So you were told, and a before tax cost of debt of 7%. So you discount it using before tax cost of debt of 7%. So what will be the discount factor for 6th year? Since it is, we've grouped year 1 to 6, we are going to use the annuity formula. 1 plus r is to power minus n over r. That will give you the discount factor. So for better understanding, go and watch my presentation on cost of debt. So R is 7%, N is 6. So that means you'll be having 1 minus 1.07 raised to power minus 6 over R, which is 0.07. So we have 1.07 exponential minus 6. When you take it away from 1 divided by 0.07, then it will be approximately equals to 4.766. 4.767. 4.767. In the 6th year, for year 6 alone, you are going to use the present value of compounding 1 plus R raised to power minus N, where R still remains 7% and N is 6. So 1.07 raised to power minus 6, and that gives us 0.66. 0.666 for year 6 alone. What is the present value of that? Amount in million. 8 times 4.767. That gives us 38.136. 100 times 100 times 0.666. That gives us 66.6. So when you add it, so the present value will be the sum of that plus 38.136. So we have 104.736. That is the value of the bonds. Now, what will now be the total market value of all the bonds? Since the market value per share is 104.736. So the total market value now, total market value will be 104.736 times, and the bonds you have is 120 million of nominal value of 100. So now we have divided by 100 times 120 million. Therefore, total market value of the bonds is 125.7 million. That is the solution. So we now come here. Our market value is 125.7. What will that be the hard total? 125.7 times 4.9%. That gives us 6.159. So what will that be the total of the hard total? Plus 1.68 plus 68. We have 75.8393. What is the total of the market value here? The market value is 680 plus 40 plus 125.7. That gives us 845.7. Therefore, what is the cost of the bonds? Cost of the bonds. Okay, we've estimated the market value. What is the cost of capital? What is the weighted average cost of capital? Weighted average cost of capital, which is hash total over total market value times 100. And our hash total is 75.8393. 75.8393 over what is the total market value, which is 845.7. 0.7, that is the total market value. 845.7 times 100. Therefore, WACC equals to 75.8393 divided by 845.7 times 100. We have 8.9676, approximately equals to 9%. That is the WACC, weighted average cost of capital. This is the end of my presentation on any basis or any method of business valuation. So my next presentation, I will examine the cash flows method of valuing business. Thanks for watching Ezikan.